Hello, everyone, and welcome to our 2022 Economic Outlook, Bridging the Gap from 2021 to 2022. Hopefully, you've had some time to enjoy a little bit of music. This is currently Carrie's Boat playlist, so we'll just start it off well with that. But we're going to go, as you probably already saw some of the poll questions, we appreciate you answering them. By the end of the presentation, we'll kind of go over those, as well as a 10-minute Q&A session, so make sure you have your questions prepared for that. We ask that you only use the Q&A box and not the chat feature. This is for compliance reasons. We don't really know why, but yes. So anyways, let me introduce myself first. My name is Claire Olmstead, and I am currently training to become an advisor here at KWB. I am reaching my 6th month and have learned more than you could ever imagine from your presenters that you're listening to today. So I will be behind the scenes today. So if you see any technical problems, you know it's probably on my end. But with COVID, it's taught us, of course, to adapt and learn the virtual way. So my second role here is also to take care of some other items. So first and foremost, I'm going to go ahead and test my controls going to the next slide. Okay, glad to see that this is working. So this is our disclosures about our business and the investment advice we offer. So just please, carefully read this, look through it. And also please note that you are going to receive a follow-up email within 24 to 48 hours with a link to view this recording for today's webinar, just in case you miss it or your Wi-Fi cuts out or whatever the case may be. So once again, please don't use the chat feature, and we'll get to the Q&A and the poll questions at the end. And without further ado, I'm going to go ahead and hand it over to the one and only RMC Open Mic.
Thank you, Claire. Appreciate it. You may be wondering who Open Mic is. It's Mike Razook, and shameless plug, if you haven't tuned into any of my Social Security sessions, we have them available on Facebook. Before I jump into today's content, you're probably wondering, it's a Zoom meeting. Are all the KWB advisors actually wearing full outfits? I guarantee you we are. So no pajama bottoms here. So let's dive on in. Igor, what happened in 2021? Honestly, it just kind of feels like an extension of 2020, in my opinion. This year is doing the same. So the lines have blurred. What were some of the expectations that we had last year versus what actually occurred?
Absolutely, Mike. And definitely, like you mentioned, 2020 was an interesting year. We had one of the shortest recessions in history. We also had one of the quickest turnaround times for vaccine development. As December was coming around and 2020 was coming to a close, we actually looked at the vaccine rates, opening up the economy, and seeing how consumer confidence will bring back some of that spending and really boost the market upward. And so if you look fast forward to now, in reality, about half the world is vaccinated. In the United States, California is leading the way with about 67% vaccination rate. We weren't as right on the travel part of it, however. Travel picked up, but it's still not where it used to be. I think 2/3 of the flights pre-COVID levels are actually getting booked now. So we're still pretty far off on that end. But like we mentioned, we thought that the consumer confidence would get boosted by the vaccine. And since most of the GDP is consumer spending, we thought that would translate to a good year in the markets. Some of the things we did not foresee, however, was the supply shortages and the housing market boom, which undoubtedly added to the inflationary pressures. Inflation was actually up 7% in 2021, the highest since 1980s. And like we mentioned, we thought there would be some inflationary pressures, but we didn't really know it was going to be this great of an extent, partially because of the stimulus that was injected into the economy. And again, the housing boom and the supply shortages definitely added to that.
So Igor, did anything stand out last year as kind of a big surprise to you?
Definitely the inflation again, and the housing market probably. We also looked at interest rates and saw if they're likely to change. And we didn't think that they were going to change in 2020, 2021, 2022 and forward. That is likely that they're going to start getting maybe a little bit higher. But as of now, interest rates still aren't really paying much. Stocks are really the best exposure to return.
Thanks. So I'm a nerd. You're definitely a portfolio nerd, though. So can you share a couple things that KWB did in client portfolios last year and how we supported clients just in general last year?
Yeah, absolutely. It's really hard to pinpoint one specific thing that we did, since everyone's portfolios are so different, and we might do things differently in someone who's a little bit more conservative versus someone who's a little bit more aggressive. But on average, I'd say we increased our equity exposure. Partially the logic for that was, interest rates aren't really paying that much. Inflationary pressures are likely to persist, at least for 2021. And we thought that increasing our equity exposure on average 5% would be a good call. And it turned out to be a good one. Some of the other things we did are part of the financial planning and coaching that we do with our clients. Strategies like having enough cash on hand in case the markets go down. You don't have to take a distribution that's a larger percent of your portfolio. You could just stay invested, take some of that extra cash that you had, and once the markets recover, you can refill that bucket. From the tax perspective, this was a busy year too. We monitored but did not react to changes in the proposed tax plan going forward. But one of the things we did start doing a little bit more proactively was Roth conversions. We thought, if taxes are going up in the future, which is likely, why not pay the taxes now and have some of your money going tax-free as opposed to tax advantaged? So that's one of the other things that we kind of accelerated this year and tried to push our clients to do.
This is a big one. We focused on what was happening with tax proposals, but we didn't necessarily react to them. And we had lots of phone calls about people wanting to give away their estates, do these massive tax reactive policies, and not much really ended up coming out of it. So let's talk about that a little bit. Let's shift over to Mr. Bub. Carrie, we want to talk a little bit about the BBB. Are we talking about investment grade bonds, the Better Business Bureau? Give us a bird's eye view, please.
Yeah, so when I look back to last year and the BBB and everything, I think it taught a lesson, or should have taught a lesson to investors about not being so reactive to what they hear in the news. It's a lot far from getting something done than saying something. And so, like Igor and Mike said, early on in the year, we had a lot of calls about, taxation, lack of or increasing capital gains. And it was really targeted at the higher end people. Unified gift credit's going to decrease, and should I give away my state? And so a lot of these things that we all got worried about never really materialized. Today, I think the BBB is, in the intensive care. And basically it's on life support with, ventilators and maybe feeding tubes. And I don't think you're going to see much happen or come of it. There's a few things that they would certainly like to get passed, which is the child care tax credit, maybe some environmental issues. But I would say that, those on this call, the things that might happen with BBB this year, if anything, are very, very minimal and will infect investors probably very little. And I will assure you that if we see some kind of change, that we will be reaching out and telling you how to maybe reposition or act in the event that something does happen. But yeah, a lot of times there's a lot of news and drama, and sometimes you got to have your filter on and just kind of chill.
So Carrie, the September 13th version of the bill, it seemed like it heavily targeted wealthy individuals, people making over $400,000. And then the House did a complete 360, released a bill that set the sights really on corporations instead. Do you expect this to actually go anywhere?
I really don't, Mike. I think that, they just can't, even though they have the majority in the Senate, they just can't muster all the votes. They've got two people that aren't willing to sign a board. And so I don't think it's going to go anywhere. But to be said, what Build Back Better was trying to do is really bring forward kind of to some degree what's going to happen in 2025. If you remember, the Trump tax cuts were temporary. They were 10 years or 8 years, and they kind of, expire. And then we kind of go back to some of the higher taxes that we paid prior. So, that's one of the reasons I think conversion still makes sense. Better to pay the devil than the one you don't. Tax rates likely higher in the future. But I don't think in the next 3 more years here until we get to 2025, you're going to see any significant changes, maybe a little bit on the corporate tax side. But it just doesn't seem that they have the votes to get that done. Yeah,
and unfortunately, it seems like when they do the research, taxing individuals, it brings in good revenue. Corporations brings in good revenue, but it almost seems like they need to do something even more substantial. I know that they've done value-added taxes on purchasing goods, things like that. And that seems to be the most effective way to actually fix a problem in the U.S.
Yeah, that's what they do in Europe, especially this program was really a very big tax and social spending program. something we hadn't seen as drastic as, in the last 50 years or so. And at the end of the day, like I said, I just don't think the commitment to do that was there. Not yet, not for this country. We're just a little different than the Europeans.
Igor, I know it's been a little while since we've heard from you. Kerry just finished discussing the Better Business Bureau. Just kidding, the Build Back Better Act. And he doesn't think it's going to go anywhere. What would that mean when we're talking about tax revenue for the United States? I mean, with all the stimulus money, spending initiatives, the existing debt to service, what's happening with the U.S. deficit? So before we do that, Claire, can we just check the clock? Okay, well, it's almost 30 trillion o'clock on the U.S. debt clock. So Igor, is it time for investors to be worried?
Mike, it's not ever a good time for investors to be worried, but it is a good time for investors to plan. So the reason we hear a lot about the deficit and the debt, and keep in mind, the deficit repeated is what really makes the debt. It's a combination of all the previous deficits and shortfalls that the United States government had that they had to borrow. So is it time to worry? Not necessarily, but it is something to keep in mind and look out for, especially in 2020. If you look at the numbers, the little chart that we have on the screen shows over the last 90 years, 23 trillion of debt was added to the US debt. And in 1 year alone, in 2020, that increased by almost 20%, almost $5 trillion in a single year. It took us $10 trillion to go in an 80-year period from 1928 to 2008, and we did half of that in just 1 year. So that's part of the inflationary pressures that we see as a result of all the stimulus that was pumped into the economy. Like with everything else, it's never really that simple. You have to look at several things in order to kind of make sense of how bad the deficit is and if it's really a problem that's prevalent now. Specifically, interest rates play a big role. If interest rates are low, the amount the United States has to pay to service their debt isn't as great. In fact, since interest rates decreased in 2020 as a result of COVID, the payment for our debt went down, even though we took on more debt. So that's one of the interesting dynamics there. Another factor to look at is GDP, which is just another way of measuring a country's growth. Like companies have earnings, countries have GDPs. So if the GDP is growing and our economy is growing, we're developing, expanding, that isn't necessarily a bad thing. It's needed to continue to grow and flourish. And as long as we can service that debt and our GDP is growing, which I think we'll talk about shortly, it is. And there really shouldn't be a need to worry. It's no different than the situation like in the 80s when the deficit and the debt was getting a lot of headlines. So nothing really changed from that point till now. It's still a big number.
We see this big jump in 2020 to deal with COVID, $4.8 trillion. But, we only spent 1.8 during the Great Recession of 2008. It looks like we really spent about the same. It's just, inflation has kind of changed those numbers.
You are a Social Security nerd, Mike. You got the numbers exactly right. If you actually look at how much debt we had accumulated leading up to 2008, 10 trillion, and you'll look at how much we needed to take on to get out of the 2008 recession, was about 1.8 trillion. That's 18%, exactly the same as in 2020. So yes, you are right. It's a similar reaction. It's just an inflated number. So that's definitely plays a big role. And the other thing to look at too is a lot of the headlines talk about the US debt. They don't really talk about the US assets. So really, to put things in perspective, US has about 200 trillion worth of assets. This is comprised of land, oil reserves, natural gas reserves, gold, military assets, etc. So there is a lot of assets on the other side of that coin that don't really get addressed as often or as much. So that's always something to keep in mind as well.
Right. And so you're saying look at both sides of the balance sheet. You don't just focus on the debt. You got to look at the asset side too. And the value of those is increasing along with the debt.
Exactly. Like I said, if GDP is growing, the country is doing well, then you're going to have a growth on both sides of that balance sheet. So as long as your assets are growing, it's natural for our liability part of the equation to grow as well. And, in the future, if it does become an issue, the United States government really could only do two things. We could decrease how much we spend, or we can increase how much we make by taxing more. So even though the BBB might fall through, or there's only really two ways that this deficit could be lowered and the debt can be brought down. It's reducing spending or increasing income. And we actually talked a lot more about the deficit back in our 2020 Zoom In Week presentation. And if you wanted to know more about that and refresh some of those slides, you can find it on our website under the resources and events tab. and it's the 2020 Zoom In Week.
Bob, little story. I went to the store the other day to buy a chicken to make a marsala, and they had those 3 packs of chicken breasts. I mean, we're talking maybe 6 pieces of chicken. It was $27. What the hell is happening with price inflation?
Well, I'm glad you were able to find the chicken. What was it, a year ago? We were having difficulty finding paper towels. And so I'm glad the chicken is available. But yes, prices definitely have gone up. And we get a lot of questions from clients as to why does the Fed have a 2% inflation target? And the reason for that is over the longer term, really over the last 40 to 50 years, it's just a historical norm of inflation. And that's why the Fed has that target. But the reality is what upsets investors is when we have either too little inflation, like we did in 2008 when we had deflation, or as we have at the moment when the government announced last December that the US is running at a 7% inflation rate. That's a lot higher than the 2% target rate. That's what upsets investors. If you look under the inflation rate, really the components of that inflation rate. The reality is it's gasoline, it's new and used cars, it's energy, it's food, and as I said, new and used cars. It's really everything that we need. It's products coming out of a pandemic, not necessarily services. And so I'm not convinced that we've got long-term inflation. We definitely are seeing higher inflation. But I think we need a couple more months of government reports to give us an idea as to whether we're truly dealing with long-term inflation.
Right. But Jerome Powell did come out the other day and say that we got to remove the word transitory from our vocabulary, right?
Industry getting back to work and everybody going back into the office may delay the U.S. economy getting back to full steam. But as I said, we'll need a couple more months, maybe by mid-year, to give us an idea whether the high prices and the inflation that we're currently seeing are maybe caused by some short-term issues that occurred during the pandemic. The other thing that we look at to give us a clue as to whether we're truly dealing with long-term inflation is the 10-year Treasury bond. Before the pandemic, 10-year Treasury was around 2.75%. Today, it's about 1.75%. So that's a third decrease over the last 2 years, if you will. And so the world doesn't think that we're dealing with long-term inflation yet. So I'm not convinced that we're there.
Okay. Well, what should investors be doing then to protect their wealth from inflation? I mean, we used to have that saying, cash is king, but does that saying need to be revised at this point?
Well, we do like to have cash, definitely. And our job as wealth managers, as your wealth manager, is to manage that risk. And so one of the things that we look at, this chart that we have in front of us goes from 2007 to 2021, and it goes to give us an idea as to what asset groups perform well during this period of time, and which were large cap stocks, annualized. And at the bottom, the worst performing group going from top to bottom were commodities. And so if we're truly dealing with long-term inflation, commodities are cheap, to say the least. The other thing that I would point out, the fourth cheapest, if you will, are international stocks. And so we have an idea as to what does well over a long period of time, maybe peters out, and what's cheap comes roaring back. The other thing I would highlight in looking at these, if you look underneath these sectors, the stock sectors, from 2010 to 2020, tech stocks, large cap tech stocks were the best performing group, and the worst performing group was energy. Interesting enough, year to date in 2022, tech stocks are the worst performing group, and energy is the best performing group. And so if we think that inflation is coming, maybe we should have greater exposure to commodity stocks.
Right. So you talked about the hunt for yield. I mean, what about like dividend paying stocks, things like that?
Yeah, we like dividend paying stocks. This gives us a clue, maybe what some options available to us to make some money off of long-term inflation. If you look at 2010, really a period of low interest rates, low inflation, the return that you got off your stocks, only 17% of it came from dividends. 83% of it was prices actually going up, your stock going up in value. And so let's look at a period when we were dealing with high inflation in the 1970s. Prices of stocks really didn't go up. Most of the return that you got off the stocks were the dividends. 73% of your stock portfolio's performance came from actual dividends. And so that's something that is available to us. And so I like dividend paying stocks now, and if long-term inflation becomes an issue.
What about bonds? I mean, we have lots of bonds in people's portfolios who tend to be more conservative, but what happened to them last year?
Yeah, well, last year I think is maybe an indicator of what concerns us, frankly. Last year, with the risk of inflation popping its head up, bonds actually didn't do very well. One of the indicators that we look at is the AGD index, which is a diversified bond index. It was actually negative last year. It was down 1.75%. And frankly, year to date, it's also negative. And so if we're truly dealing with long-term inflation, we may want to look at reducing our bond exposure. And so if that's the case, maybe 70-30 is the new 60-40, having 70% in stocks and reducing our bond exposure. And so once again, if we're truly dealing with long-term inflation, commodities or alternative investments are an option that we may want to look at. I would definitely overweight dividend paying stocks, and foreign stocks are a good buy, and they pay higher dividends.
So bottom line, I mean, it sounds like we got some ideas. If we do think that inflation is going to be around, we're still trying to wait to evaluate whether that is going to be long-term, or, once we fix the supply chain, if the problem gets fixed.
I agree.
Thanks. So let's talk about supply chain a little bit. Diana, as you know, I like to mountain bike, just a little, but almost every time that I need a part, it's out of stock. I mean, I just waited over 24 weeks to get some stone delivered from my backyard. So Bob discussed inflation, and it seems very tied to lack of supply. What's happening with the supply chain?
Yeah, absolutely. I think most of us experienced some sort of delay last year. And so what we saw during the pandemic is that the demand for goods increased drastically. And the issue was that some companies couldn't handle the demand. Maybe it was, lean or just-in-time inventories that caused the problem. And so, with the supply issues, we saw shipping delays, the ports were backed up, worker shortages, maybe because of COVID, they were out, and cost increases. So the cost to ship went up drastically. And so with all of that, companies are really starting to make changes. Maybe they're changing suppliers from a different area. Maybe they're okay with paying more to have dependability. And so, I don't know about you, but I order a lot from Amazon. And so we probably didn't see, much shortage there or delays or anything, because Amazon is a large enough company, among other companies, that they charter their own cargo ships, and they didn't want to deal with backed up ports or whatever. And so supply constraints, they tend to really hit the smaller companies. So, and maybe it's also that corporations don't want to deal with China or what have you. So I think we're seeing a lot of supply diversification, and companies really want just dependability. And so I think what we're seeing already is that the supply constraints are easing, but who knows what the Omicron variant is going to cause. I just talked to a client yesterday, and he mentioned he needed lumber. And I know lumber has come down quite a bit, but the day after Omicron was announced, lumber went up $20 per foot at that particular store. So you're seeing all kinds of odd things happen. But as far as supply, we think it's improving and probably will continue throughout this year.
Yeah, so it kind of seemed like maybe during the pandemic, we couldn't get out and travel and, spend money on services. So people kind of shifted to just buying goods. You mentioned staying at home and buying stuff through Amazon. So, we always hear these stories about the 100 container ships in the harbor, lack of truckers, things like that. But it sounds like lots of the problem was just really increased demand for products.
Right.
Okay. Well, I think that's a good segue into the housing market, because we know that, low supply, high demand typically means higher prices. And I'll tell you, my father-in-law, he works in the housing sector and works with developers, and they can't keep up with demand. How's that impacting housing prices these days?
That's true. So we're continuing to see home prices climb, and also demand. That really hasn't changed coming into this year as well. The issue is still low inventory. though. We are seeing home builders, applications are increasing and builds are finishing. It just they can't keep up with demand. So what we saw already beginning this year, the median home price reached almost 359,000. That's up 14.5% just year over year, and then almost 30% from 2020. So home prices are continuing to increase. What was interesting in the next chart, you'll see that homes sold above list price. I'm sure many of you heard last year this occurring, and so we're still seeing it. About 41% of homes are being sold above list price, and that is up from last year. And then in 2020, around 20% of homes were being sold above list price. So that continues to happen. And then the last chart here, what's very interesting is active listings. Look at this. So we are down 28% active listings from last year, year over year, and almost 50% from 2020. So huge decrease in active listings. Inventory is still the issue.
Yeah, it's pretty substantial. So it's not that people don't want to buy houses. It's just there's not the supply still.
Right.
Okay. Well, do you think then are we headed towards a housing bubble?
There's kind of a bubble, but we don't think that there's necessarily going to be a housing recession per se. So there's still a huge demand for homes. And so that we think will keep prices stabilized, but and probably increase according to this forecast. And so what we think may happen though is that as interest rates increase, that prices may come down and level out, but not necessarily a recession per se. And in looking in this year, we looked at Realtor.com and Redfin just to get some insight as to what they're seeing and what they're thinking for this year. Again, as I mentioned, home prices are going to continue to increase, maybe around 3%. Sales to increase between 6 and 7%. We're still seeing that shift from the city to the suburbs and out of state. People are relocating and going all over the US. That should continue. Millennials are ready to purchase. I actually think millennials were ready to purchase, last year. It's just, maybe they were outbid. So millennials are ready to purchase. And, what we're seeing though is that if rates rise, which they're anticipating, mortgage rates, that, that will put some pressure on people, maybe millennials in general, but it'll put pressure on them to purchase homes. And so I know before we mentioned we were kind of focusing more on house prices, but mortgage rates are a huge factor in purchasing a home. Rents, they think rents will increase about 6 to 7%. And then, as I mentioned, rates increasing. I think they're actually already around 3.5%, maybe just over 3%. Yeah, I saw that. And so, they're anticipating maybe 3.6. Who knows? But we all know that mortgage rates are probably going to go up.
Right. It's like you said, check that box. There we are already at 3.6.
Yeah.
So, let me ask this: with millennials really wanting to purchase, you kind of said it's more or less just delayed their ability to with these massive price increases. And so I personally think that we'll continue to see some strength in the housing market because we still have the demand from millennials and people who want to buy those houses, start those families, things like that. I mean, do you think that we'll continue to see that price stability as well?
I agree. If they were outbid last year, that doesn't stop, them wanting to purchase a home. So they're just looking at this year. So yeah, I think the demand's going to continue.
One of the biggest reasons why people have joined the call today is we've had some recent market volatility. And I'm sure lots of people are tuning in to kind of hear our thoughts about the stock market. So Carrie, just in general, what drives the market? Where do you think it goes from here?
Yeah, thanks. And we did these slides maybe a month and a half ago as we have to get them through compliance. At that particular time, the markets were going higher. It's just been here in the last, 2, 3, 4 weeks that we've seen more volatility. So, what drives the market is probably a little different question than what causes the volatility. But what drives the market is economic prosperity, consumerism, a desire for mankind to have a better life. You're just talking a moment ago about millennials want to start a family. And so as we have a growing economy, as we have GDP growth, as we have a better life, and we have the innovation, the technological advances, and all these things That's what's going to drive the market higher in the future. Now, in the meantime, we have what causes all the volatility, right? That's the stuff in the news that's kind of making us look at our statements and wondering what's going on. And these are kind of the things that happen all the time. And currently, the things that we're worried about or things that are causing the volatility is the COVID, the Omicron. What about inflation? Is it transitory or is it permanent? Like, we're talking about here a few minutes ago. How high will the Fed have to raise interest rates? And if the Fed raises those interest rates, will they go too far? And they raise rates too high, and all of a sudden they choke out the economy and economic growth begins to, dissipate. The job market, what happens there? And then we've asked the question about the housing. Is it a boom or a bust? The last recession was kind of caused by the housing market. So I say what drives the market is the optimism, the mankind's kindred spirits, tiger spirits to move forward. What creates all this volatility is all the things we worry about that often never happen. But you know what? It makes great news, it makes great conversation. So, for those investors that have been, watching their accounts too closely, I would encourage you to, tune it out some, put more filters on, go out and take a walk, not look at things quite as closely.
So, Kerry, last year we had a market that was pretty stable. I mean, we had some of the most new highs in a single year. How high does the market go? I mean, does it keep performing well from here?
So kind of depends on your time frame. If your time frame is 1 week, you know what? I don't know where it goes in the next week. If it's 30 days, same answer. But if your time frame is, 1 year, 5 years, 10 years, for me, it's the rest of my life. And so the market is going to go to 100,000 on the Dow. I can't tell you when. We're also going to have a recession at some point. I can't tell you when either. So what drives the market is ultimately going back to optimism, the growth of the economy, the kindred spirits of mankind. And I think it will continue to go higher. In 1998, a gentleman named Jerry Masiegel wrote a book called Dow 36,000. And everybody thought that was crazy. Dow 36,000. Well, just before this sell-off, the Dow was at 36,000. So nobody knows how it's going to get there. But I would say being optimistic is certainly been more profitable than being pessimistic. And the key for investors is really to make sure that you have a margin of safety in your portfolio, so that if we go through these bumps and bruises along the way, you're not panicking. You have plenty of cash and emergency funds to meet your needs, to take care of those things, weather the storms. And also, if you stay diversified, then the bumps and the bruises aren't going to be as big. You're not going to make as much sometimes because you didn't have all your money in one place, but then you're not going to lose as much or have as much volatility when something, craters like here recently. I think cryptocurrencies are down about 50% or something, from their highs, since November or something like that. So U.S. markets are going to keep going, but part of the process is just expecting this, every year and a half, 2 years, these pullbacks.
So, Kerry, we always hear that focus on the long term, focus on the long term. Any short-term advice though for investors during these volatile times?
Any short-term advice I would say is if, one of the things that I got ready on my desk here is to do a partial Roth plan conversion in my 401k. And what I was trying to do is if these stocks really get hammered, I'm going to convert when prices are low so that I can enjoy the growth in a tax-free account. I funded my Roth IRA as soon as I could and actually invested the money in the last couple of days. So I would say, be an opportunist, not someone that is, a victim. So when we have lower prices, try to take advantage of that and invest money. That's the best time to invest. And, if you're psychologically having more challenges, then, really it's more healthy not to look at the statements as much, to turn off the news a little bit. But like I said, I would rather be an opportunist than a victim when you have this kind of volatility.
Yeah, I agree. I like to remind people that I work with of that as well. Let's talk a little bit about the R word. Historically, we've seen a recession every 7 to 8 years. It took 12 years for us to get to the last one. When's the next one, Kerry? And if you can't tell us that, what do you think will cause it to occur at least?
Yeah. So, we're definitely going to have another recession. The question is it 1 year? Is it 3 years? Is it 5 years? Australia, they went actually, I think 47 years without a recession. And a recession is when you have negative economic growth. In other words, the economy begins to shrink, GDP actually declines. So in 2021, our economy grew roughly at 6.3%. So to go into a recession would mean, boy, we'd have to give up all those gains and actually start contracting the economy. So I don't see a recession anytime soon. But what does happen is ultimately things go into excesses. Maybe the Fed raises rates too high, trying to slow that ugly inflationary pressure. And as rates go too high, consumers can't afford homes, companies begin to lay off, people lose their jobs, confidence diminishes. And then all of a sudden, we have a shrinking economy at that point. That would be the reason of the next recession, probably. Or if there's some black swan event out there, is it Russia attacking Ukraine or something else that could possibly shake the markets per se. So when is it going to happen? I don't see it in the forecasts, and I'm going to say, I don't see it at least for the next 18 months. It just seems like, consumers, workers are too confident. They're spending money. People are actually leaving jobs without another job because they're confident enough they can get a job at maybe a higher wage. So I don't see it anytime soon.
Well, and I know, just as a reminder to investors, we can still see a bear market in a year that we don't have a recession. It's not very common,
Right.
But it can still happen. But the majority of the time that we don't have a recession, in the 80%, the market's actually higher for the year.
Correct. Absolutely. Yes. So, barring a recession, there's a reason to still be optimistic. Now, that all being said, the markets are not cheap. The markets have had a phenomenal run. And, Bob alluded to, well, maybe some of the big winners that have been winners recently, like technology, maybe you start seeing a shift to some of the other areas. Those are pretty hard things to time. And, we've been big believers in international stocks, right, Mike? But yet they've been cheap a long time. And you keep wondering, well, when's that catalyst? What's finally going to move it? And it is so hard to predict. It's better to diversify, be patient. That usually is the winning strategy.
Perfect. Thanks, Kerry. Let's talk a little bit about what's happening abroad. So, Bob, we get lots of exposure to what happens in the U.S. We get the news inundating us as far as what's happening here. But what's going on with some of the other notable economic powerhouses?
Yes, we do definitely get questions regarding China and Russia these days. They're top of the news. Let me highlight just some economic strengths and weaknesses associated with both. Obviously, with China, it's a very large population, largest of any country on Earth. They're the largest manufacturer and an exporter. And so they need the world to grow in order to keep those manufacturing plants working. They're also very rich. They've got the second largest number of billionaires in the world and millionaires in the world. You contrast that with Russia. Before I get to Russia, let me highlight the weakness of China. China is really weak in natural resources. It actually imports 73% of its oil. When you look at the energy that China uses, 60% of it actually comes from coal. And they're actually currently importing 84% of their semiconductor chips. And so they need natural resources. You contrast that with Russia. Russia population is very smart, the third largest number of scientists in the world. And they're definitely a natural resource powerhouse. They're number one in natural gas reserves. They're number two in oil, and they're in with the top 10 for oil. Number two for coal and the top 10 for oil. And so very strong natural resources, actually so strong, their weakness is really too much in natural resources. 60% of the Russian economy is attached to natural resources, which makes their economy very cyclical when it comes to the world. And so we do get questions as to whether Russia is going to invade Ukraine or China is going to invade Taiwan. And I really don't know the answer to that. If Russia does invade Ukraine, it's not going to be for natural resources. They got enough of that. But we always try to direct them to really a larger issue as to why you should have money outside the U.S., why you should diversify your pot, if you will, and not keep it all in one country.
Yeah, Bob, I mean, that's a good question, because the reality is, you look at U.S. markets have outperformed international stocks for over 10 years now. So
And I have.
why should we invest in international stocks?
Well, and we keep saying that, right? And we expect at some point international stocks will be the best performer. But I think the larger picture is just reminding the clients as to why we have so many outside the United States. Obviously, we want to participate in the growth of the world. 85% of the world's economy is actually outside the United States. So if you only have US stocks, you only got only 15% of the economic pie, if you will. Most of the growth going forward of the world is actually going to be outside the United States, and in particular, the developing markets, emerging markets like India and Brazil. And obviously, we want to diversify our portfolios. You don't want to keep all your eggs in one country. And as Igor may have alluded with the debt of the United States, maybe we should have some exposure to things other than the US dollar, just to hedge if the dollar has some difficulties going forward. And so when to invest in international stocks? When it's cheap. And so the chart that we have in front of us just reminds everybody, there are times when US stocks outperform, which is the above the line, and when international stocks outperform, and that's below the line. We just ended 10 years of US stocks outperforming international stocks. International stocks are cheap, they pay higher dividends, and maybe their time is near. And so we keep harping, have some money outside the US. This may be a good time to have a little bit more of your exposure outside the US.
Right. And lots of times they kind of seem like the lottery. You get these big pops and big chunks. All of a sudden, international or emerging markets might be up 50, 60, 70%. And so if you're not playing the game, you're not going to win. So it's still important to have some exposure to those markets if they do have a blowout year.
And Mike, I would highlight, look at year to date. I realize it's pretty, we're only done with a month. US stocks are negative. Emerging market stocks are actually positive year to date, up 1%. That's why we diversify.
Well, I appreciate that. So I have a saying that I think Steve had shared with me, our portfolio strategist, and it says, diversification is giving up great for good while avoiding terrible. Let's jump into a particular piece of wisdom from each one of our panelists. So Bob, why don't we continue with you? What should we remember for 2022 and beyond?
I always highlight, keep a long-term view. It's always best to keep your eyes on the prize, which may be down the road a couple of years. Success in investing, especially when it comes to stocks, is not trying to time the market, but the time in the market. So the longer that you're in, the greater chance for success. Keep that long-term view. And as Carrie had alluded, don't watch TV. Media sells bad news. And so if you're getting overwhelmed by the media, walk away from it.
Diana, how about your piece of advice for
Yes, sir. So kind of piggybacking off of what Bob said, so the long-term approach. Last year, I heard a lot about fear of missing out. So really my advice would be a boring investor with a tried and true plan. It's better than being a stressed out investor and trying to make a quick buck. We've heard Bitcoin and everything last year. So just have a plan and just stay in it for the long term.
Igor Nikichin?
Adapt. My takeaway from 2020 and 2021 would be to be able to adapt to changing environments. Look at Disney. When COVID came, they had to shut their parks down. Normally, companies would take a pretty big hit. Not Disney. They adapted, innovated, and came up with a solution. Clients who do the same during down markets are going to be just as successful during volatile times and environmental changes. Take lower distributions if you can, and make sure you're taking appropriate risk.
And finally, Mr. Carey-Bub?
Yeah, I would say financial decision-making shouldn't be related to the headlines and politics. So many times we hear people calling in and saying, well, if this president's elected, I want out or whatever. So it really is important to not react to the headlines and the politics, because as it says there, everything one fears rarely ever happens. And then my last bit of advice, and put it in a mathematical formula for the engineers out there, is being patient, having an optimistic attitude about the future and that mankind's going to be okay and the world is going to continue. Subtract a little bit of the media exaggeration and filter out some of that noise. And if you can do that, you're probably going to have investment success.
Perfect. So Claire, I think that you had a couple housekeeping items to finish out the content before we jump into some of the questions.
Yes, of course. Thank you, Mike. Thank you again to all of our presenters. So at this time, we are going to do the Q&A session that I previously talked about. It's going to be about 10 minutes. So if you haven't already, please utilize that Q&A feature. Remember not to use the chat. Also, just know that they have worked really hard to create meaningful content. So when you do get the follow-up email with the survey, please fill it out, give us your feedback, and let us know how we can make our next webinar better for you, what you want to see on our social media, website, just whatever you want with your content. Also, just please see this slide if you have any other questions, give us a call, contact us. We'd love to hear from you. So you can also go to our website for more information on our upcoming events, Facebook, LinkedIn, whatever the case may be. So my last item for today is to stop sharing our screen and put our presenters front and center for the Q&A. And I'm also going to go ahead and release those poll results as well for everyone to see. And with the poll results and the questions, I'll just go ahead and give it over to Mike.
All right. Are we going to pull up that poll? There we go. The answer to the first one. So since 1950, how many double-digit corrections has the S&P experienced? So it looks like the most popular answer was 24. The answer was actually 36. So we've actually seen it happen about every 2 years. We have a pretty significant correction, so 10% or more. With question number 2, it looks like the majority of people thought it was 81%. So then the question was prior to this month, last 10% correction occurred in February to March of 2020. So what was the S&P return since that bottom? It's actually been about 113%. Good poll questions. Let's turn it over to some of the questions that you had on the Q&A session. So we have one here. How do you decide what stocks to sell for required minimum distributions? Anybody want to chime in on that?
So this is Kerry. I'll chime in. So really what we do there is we look at the individual portfolio, where a client is allocated, what kind of market we're in. So let's say, we had to take an RMD and it was, we'll call it March of 2020. The market was down 34%. And a client calls in and needs to have that money. Then generally we're going to go and take the RMD and sell bonds, because the last thing we want to do is sell equities when the markets are low. If you happen to call in and it was December 2021 and the markets were at or all their near-time highs, then often we'll come in and, all right, let's rebalance. Let's take some of the money off the equity side because we have done so well. So it's not just, let's just sell across the board. There's a lot of thought going behind the scenes. What's the prudent thing to do depending on when the distribution occurs. Some people take it like on a one-time every December. Some people take their RMDs, throughout the years. So we're kind of always managing that.
Thank you, Kerry. Next question. So if you're retired, age 80, you got 2 income streams, just required minimum distribution, Social Security, maybe a tiny bit of rental income. What type of portfolio would we suggest for a person with that criteria?
I could take a stab at that one. I would say we'd have to take probably a closer look. What are your expenses? If Social Security alone is enough to cover all your expenses, then you feel comfortable with taking the risk, then you can be invested aggressively if you want. On the other hand, if you need substantially more income and you're kind of relying on your portfolio and you don't have an appetite for risk, then we might want to be a little bit more conservative, where you're not going to see exceptionally great returns and you're not going to get full participation of what S&P does, but at least you'll sleep well at night. And if you take a prudent percentage, 4 to 5 usually is what we recommend, then your portfolio should last. Should last.
Yeah, and just to play off that, I always recommend that people invest their money according to their time frame for the money. And so if somebody is in their 80s and they think that they might be around for another 5 years and they don't necessarily look at this as a legacy portfolio, they probably should be more conservative with those funds, more money in bonds, less in stocks. But if it's money that they feel, well, this is going to get passed on to my kids, to my grandkids, we have a much different time horizon for that money. So it really depends on the situation and the length of time that we are trying to match the investment strategy to.
Yeah, and I suppose the structure too, because if it's a taxable account, you have to pay taxes, we may be a little bit more tax cognizant, as opposed to Roth, we might take a little bit more risk. So we might balance those portfolios individually a little bit different to achieve that one average risk level that you're comfortable with.
Next question. So with international stocks, not all risk is equal from country to country. How can we filter international stocks to minimize risk of unstable countries?
I'll take that one. That's why you diversify. That's why you have a broad basket of international stocks, including both developed international markets, like the Australias, the Englands, and the France of the world. But you can also attach that by having some exposure to emerging markets, which would be the Brazils, the Indias, and the South Koreas. And so I would take, yeah, there's higher risk there, but you spread that risk around by having a very diversified group of international stocks.
And I see that our portfolio director actually jumped on to help answer this question too. Steve, did you want to chime in on this one?
Yeah, I mean, the other great thing to note is that there are plenty of investment vehicles out there that we can, exclude certain countries, exclude certain companies, things like that, and still be very diversified. So if you have specific needs in that area, or specific wants where you don't want to invest in a specific country, there are vehicles out there that do that now. So we can make accommodations for that, but overall we would say you still want to be broadly diversified. You don't want to exclude something just because you may not like it, because there are going to be situations where that country outperforms or companies within that country outperform for whatever specific reasons, and we're not sure specific things going to happen.
Just chime in one thing, the humans don't often get it right. So what we do on the international is we kind of have an alpha process. So we can do an academic asset allocation, which is just, a diversification strategy across all countries. Or in some portfolios, we can actually have a manager that helps decide, let's stay out of Brazil, overweight Colombia. Let's stay out of China, and overweight some other country. So we kind of have both an academic process where maybe humans can't get it right, and then also more of an asset allocated, strategy where maybe humans can add value. And over the long run, I think internationally that has happened because, like for a long time, Japan underperformed. So active money managers kind of did not invest in Japan, and they actually did better than just broad indexes. So it's a conversation with the client and how to best meet their, goals and needs.
Perfect. Now, for sake of time, we got maybe 5 minutes left to answer questions. So let's jump to the next one. What is your opinion on aging baby boomers' effect on the current housing situation?
I'll take this one. So the effect of baby boomers on the housing market, that is going to affect supply. So think about it. People are living longer and they're staying in their homes. And the other thing is that in-home care is becoming increasingly popular. So maybe people don't want to go to nursing homes and instead have care come into their home. So they're staying longer. And so when they do finally pass, maybe they're giving it to their children, and then maybe their children are living there, or maybe they're selling. So it definitely will have an impact on supply.
Yeah, but the millennial generation is even a larger generation than the baby boomers. So I think that there's still probably going to be demand that outpaces supply. Next question, if your IRA account is growing rapidly with dividends, appreciation, how is the RMD determined when the base IRA amount is fluctuating? I'll jump in on that. So RMDs are calculated basically using your year-end account value. So the fluctuation during the year isn't necessarily what matters. It's the price at the end of the year. So your 12/31 statement is what we use to determine your required minimum distribution. And then we use a life expectancy table. So we basically divide that year-end account value by the life expectancy that you have on that IRS table. And that's how the RMDs are determined. Just a quick note, the tables have changed for 2022. So it's kind of an interesting shift, but RMDs are going to go down as a percentage of portfolios with that change because the IRS is expecting people are going to be living a little bit longer now. Next question. With the market activity in the last few days, and if the Fed does not raise rates today, do you think that this will be the bottom of the pullback?
I would just say it absolutely could be. Nobody knows. I think, we're close. And some of the more aggressive portfolios, Steve and I were talking this morning, we actually moved a little bit of money in the last day or so more into stocks. because we've kind of realized that, hey, when the market falls maybe 10%, we ought to take a little more aggressive posture. If it falls 15, maybe a little bit more, with the whole notion, that there's opportunity. Let's be an opportunist, not that victim. So we actually stopped doing that at this point because of the market rallying back, and we're going to see if we see some more pullbacks. The Fed's not going to raise rates today. I think what he's going to do is just more telegraph what he's planning to do maybe in March. And is it going to be higher, more rapid, frequent rate hikes, or is it going to be, slower, gradual over a year or two, or what may happen? So nobody knows as far as if this is the bottom, but I would say definitely use this opportunity as a time to add to portfolios. Whether or not it's the very bottom, we don't know.
A catalyst too for stocks to go up would be the earnings that are coming out shortly. So that's another big factor with corporations, and the holiday season just passed us. That could provide a pretty good boost for stocks.
And I think there's some discussion within the Fed, even though there may be a fear that inflation is roaring, as the manufacturers get back to work and try to build up the supply, and that is filters through the economy. We may begin to see inflation drop as the year passes on. And so I would agree with Kara. I think the Fed is telegraphing as to what they're going to do, but what they actually do may be a lot slower than what the market is fearing.
I think that basically wraps up our time for today, but we really appreciate everybody tuning in. We know that these are a little bit of uncertain times, but we're always working our hardest, doing our best to answer your questions, helping guide you and really be coaches during these times. My wife was joking with me the other day and just said, you should probably take a vacation day. And I told her, honestly, this is when people need us the most, when we have these times. So we're always going to continue to work our hardest for you and do the best that we can. But with that, we did record this session. We're going to make the replay available, hopefully within the next week or so, possibly sooner. So if you missed a section and want to revisit it, please look for that replay. So we appreciate your time. We appreciate your business, and we thank you for working with KWB Wealth.